It is Friday, November 20th. These two guys are bickering, and I'm not really sure what it means, but I've been hinting for months and months that something was going to happen with the Fed, not being able to support the stock market the way everybody expected it to support the stock market. We'll see if anything changes. Right now, there's about $455 billion coming out of the stimulus programs. Now, these were programs that were supposed to expire December 31st, and everybody just presumed they get extended. Turns out, not so much. So the market hasn't had a real big reaction to this just yet, but I think it could by the end of the day even. My suspicion is that the Fed is plugging as much money of this into the market as they can right now, that they're buying bonds and doing everything they can to use up some of this $455 billion. But the market is still choppy, right around even, I believe, as we speak. And I don't think we're going to get the type of year-end rally that everybody is expecting. So if you take a look at the leading economic indicators, the YouTube thing here popped up there. We can take a look at this here. Leading economic indicators are still pretty crummy. Rebounded off the bottom. That's part of the reopening, but still in the negative land. So the question becomes is, do we get a bit of a double dip? Well, if the Federal Reserve couldn't push the economy to do much of anything in the last several months, doesn't matter if that money disappears from the Federal Reserve. Mnuchin is saying that he wants to have Congress reappropriate that money into some sort of stimulus package that goes towards small business and people who are still out of work, which I think is a great idea. Honestly, anybody who wants to accuse Mnuchin of playing politics, I guess he is. However, and I'm talking to the New York Times right here, which I subscribe to and I generally like, the reality is that people have been complaining about the Federal Reserve just giving money to the rich, essentially, or to the investor class. So the top 10-ish% of the people out there are benefiting from the Federal Reserve largesse. Now, Mnuchin, I'm sure at the bequest of President Trump, but mainly Mnuchin, I think Mnuchin's been a lot more powerful than people give it credit, wants to steer this money to small business and to the unemployed. And presumably by steering it to small business, as the vaccines come on by the middle of next year, we will see unemployment go down dramatically. Now, that's the Goldilocks scenario, that we get small businesses to reopen, unemployment goes down as the vaccine starts to get rid of the coronavirus COVID-19 pandemic. I actually think it's a plausible approach. I think it's probably what you're supposed to try. We have to get these small businesses back up and running again. Otherwise, you're just looking at millions and millions of people staying long-term unemployed. And that is one of the things that happened this week. We saw the long-term unemployment number rise. We saw more job claims than anybody expected, except this guy. I told you a month ago in an article on Seeking Alpha that unemployment was going to jump at the end of the year. So how does this all impact investing? That's where we want to focus today. So the stock market is still delusional. I only had to change one word in this slide from 2 weeks ago. Valuations are still through the roof. And this is the smart, dumb money, smart money from 2 weeks ago. Notice, remember we talked about how they had both moved in the same direction, weirdly, for one of the only times you ever see it. It's very rare that smart and dumb money do the same thing. Bum, bum, bum. Alligator jaws again. So as I said, the smart money would start heading the other direction, and they did. This is a pretty wide extreme right here. This indicates that the stock market will go down in the next, I believe it's 6 weeks out, this looks. But this is saying that for the next 6 weeks, the stock market will be down. We'll see. So what we want to do is take a look at some articles. some charts. So if you've noticed over on Marginal Safety Investing, quite a bit more stuff going on. I really encourage you to take a look at Dividend Sleuth's portfolio update. He's really tightened up his positions as we talked about different REITs and other investments that are out there. I wrote about our general REIT philosophy. I did formalize our investment philosophy. The one thing that you should take away from the investment philosophy is that we do not want to invest in stocks just for the sake of investing in stocks. We want mild diversification using ETFs and stocks, but in general, we want to own stocks that we think are going to be great stocks, right? Single stock risk is infinitely high. Why? Because any stock can go to zero. So what we want is to only own stocks that can really, really beat the market by a lot. And you're not going to get all those right. But if you buy a stock that you don't think can beat its sector and beat the broader S&P 500, then what's the point of taking on that single stock risk? So I am pretty heavily tilted towards growth stocks because those typically are the ones that can beat. And when we look for dividend stocks, we're looking for total return included in our calculation. That's why when I take a look at a company like AT&T, which is out of favor right now, the reason I buy it is the huge dividend, the hidden assets that nobody seems to be assigning value to, and the idea that as those assets either produce income for them or get sold, the stock price breaks out of its trading range of the last 20 years, which I still believe will happen for AT&T. When I take a look at a company like Kinder Morgan, I'm taking a look at the fact that, and we were 2-3 years ahead on this, that those are basically irreplaceable assets, that natural gas is going to be around for a very long time, and that they're never really going to get any competition because we're just not building natural gas pipelines. Even under President Trump, there are very few pipelines built because of the various legal challenges. So somebody like Warren Buffett might decide he likes natural gas pipelines for all those reasons. Well, just so happens he went out and bought a giant one, and I've showed you the map of Buffett's Berkshire Hathaway's natural gas pipeline network now and how it overlaps with some other pipeline companies, but how different pipeline companies like Kinder Morgan, if that got acquired, would really fill in the gaps nicely for Buffett. So I do think the Kinder Morgan is a potential takeover target for Berkshire Hathaway. The maps line up, the goals line up, everything is perfect. The personalities line up. Everything says to me that Kinder Morgan is going to get acquired. And I think Berkshire is the leading potential buyer of that. He's looking for an asset in $20 to $30 billion range. There you go. That's my super hot tip. I think Buffett is going to buy Kinder Morgan soon. In any case, what kind of stocks do we want? Companies with relatively low debt, companies with high growth rates, and companies that have assets that the stock market does not properly value. This is where value is found. This is where big gains are found. You will get doubles and triples finding these all the time. And then there is growth, and I would call it hidden growth. Companies that the market doesn't quite appreciate are going to have high sustainable growth rates. Solar stocks for a long time fell into that category. There's all this negativism about solar stocks. They're never going to do this. I remember the 70s. I remember the 80s. I remember the 90s. Well, it's 2020, and the solar stocks are going to grow very fast in the next decade. And I will go out on a not too long limb right here and say clean energy stocks are going to crush oil stocks in the next 10 years. So let's get back to Mnuchin and Powell fighting it out. What is that going to do to the stock market, right? What's it going to do to the economy? I actually don't think it's going to hurt the economy. I think the economy is going to do what it's going to do. If they do a stimulus package, obviously that helps the economy, but not necessarily the stock market because that money doesn't really get back into the stock market for a very long time. Fed money gets into the stock market pretty quick. So at the bottom of the options selling article this week, I put in a interview with Jeffrey Gundlach, and some of the things that he said were exactly what I've been saying for since March, April, and May. One of the things that he pointed out, and you'll want to pay attention to the last 25 minutes, I showed this again in the ETF article, is that he thinks that American assets are going to get pummeled sometime in the next year or two. I believe that as well. I've always thought it would be sooner. Maybe I'm wrong. That's why I've been diversifying into foreign stocks. That's why we were talking about in emerging markets, e-commerce and internet ETF. That's why we're in gold. That's why we're in gold stocks. So one of the things I want you to take away today, and I will show you a chart here in a minute, is that I pulled back my gold stock holdings to around 16 to 20%. They had grown much more than what I wanted them to be at. So I trimmed those back to 16 to 20%, depending on the account. And I am looking at further diversifying my gold holdings. I have been buying Barrick Gold in the last week. I have not bought Newmont yet. The reason I haven't bought Newmont is because that is a component of the S&P 500. And as the S&P 500 goes down, Newmont will go down. So I would think that Newmont sniffs $50 a share again in the next however long, several months, but could be by the end of the year. And Newmont under 50, I think you got to buy it. It's maybe the best dividend growth story out there, with gold perpetually higher now in a higher trading range. It's not going back to $1,100 an ounce. Could it go back to $1,500, $1,600 an ounce? Well, we're sure. But it's not going to go back to $1,100 an ounce. And if it did, we should sell everything else and just buy gold. So, I encourage you to go to this webinar over on YouTube and pull up the transcript and go out to, I believe it was the 48th minute, right in here somewhere, in the 40s somewhere. He starts talking about the options and what these idiots are doing. So that goes back to the whole idea of the smart money, dumb money, right? This is not the right chart, but they always have it on the front page, right? This goes back to the smart money, dumb money. The last chart was stock market margin, which is up. Option trading is up. We pull this up here, and I'm going to have a special. They've allowed me to be an affiliate of Sentiment Trader. This is one of the most useful sites out there. So I'll have a Good Friday, Happy Friday. What is it called? Black Friday? Yeah, Black Friday special for you. They talk about too much option speculation. This is an older article, but you can put in your put call ratios, and you get to follow along with what's going on with puts and calls. So they have several different charts like this that can tell you when speculation is getting out of hand, which it has on several occasions. Popped, now it's coming back off. What we would like to see is an extreme on either side, because when it gets down here, you do one thing. When it gets up here, you do another thing. So I've been showing you a chart of the S&P 500 for months and months now. This broadening wedge, right? This megaphone pattern. It's starting to get some traction. This guy's pretty well known on TradingView. Look at that, showing the same thing I'm showing. Then you have some divergences. Relative strength index is setting lower highs. Shaken money flow, same thing. MFI is the same thing if you put that in there. Lower highs, that's never good. And now other traders are picking up on us, right? Different people keeping track of the wedge. And they all use their different indicator, Elliott waves, whatever they want to use. But they're all see that? They're all picking up on the same thing that I've been talking about for months, right? This guy's got it a little bit different, but you see that divergence and how he's projecting it'll fall like that. I think he's probably right. And then we also have the Tyrannosaurus Rex index indicator. So you got to be very careful of that. You never want Tyrannosaurus Rex to get you. So go back to my chart. Where are the buy zones? Well, what I want to show you is where the buying has been when there's a correction. So this is a weekly chart. You notice that there's very little support to about here. These lines over here are where the volume is at different prices. So there's not a lot of volume that's been keeping the stock market up above 300. That's really all generated by the leverage from the options and the margin and the easy money from the Fed, which is going to go away a little bit. So depending on how bad the economics get, you have your whole range of where different people come in to buy, which is why I think we need to scale in around 300, around 270 something. And if it gets down into the 230s, 240s again, which is what Forex Analytics is projecting in one of their projections, then you back up the bus. Now, is the Armageddon scenario still in play? I think you could see some very sharp volatility into the inauguration, but I think that once the new administration is in, you're going to see very quick action to make sure that anything that's getting out of hand doesn't get out of hand. I also think, and this isn't necessarily dependent on the Georgia elections, but I think that you're probably going to see an infrastructure bill. It may not be as big as what Democrats want, but I do think you'll see a targeted infrastructure bill. I think that Biden and McConnell can work together a little bit. Biden's going to have to get much closer to what Biden wants. However, there are things that Biden can do without McConnell, and he can hold over McConnell's head. So I think there's going to be some compromise between the administration and McConnell. If there's not, then I think you see a double dip recession early next year before things start to really rebound coming out of it. Because remember, the new Treasury Secretary can take the opposite view and allocate money to the Federal Reserve. They can allocate money to a lot of different things. So there's going to be significant stimulus next year. It's just a matter of what form and how much. I do expect that infrastructure is one of the things that gets money because I think that there's enough Republicans that would support that. We are seeing 4 or 5 Republicans consistently in that middle ground. So even at 48-52 in the Senate, I don't know that it matters too much. I think that you get some compromises, especially from senators in states where they need the work. So I wouldn't expect the complete logjam that a lot of other people expect. So I know that's a bit contrarian, but I think that the numbers in the Senate are close enough. I think that Biden and McConnell have enough of a relationship that they can work at least together in a way that McConnell can come to. And the compromise is going to have to do with taxes and regulations, right? So Biden might not be as extreme on regulations as some people would like him to be on the left, but he can hold that over McConnell's head and say, look, if you don't give me this and this, I'm going to go regulate the hell out of your constituents, right? The people who give you money. And that's usually, big corporations and things like that. So there's some give and take that they can do. There's some threats, there's some holding things over each other's head. There's some lines in the sand. But I do think that we should expect some fiscal stimulus. The problem is that takes a while to trickle in. As I have said since March, I have always said that I thought there'd be a vaccine by the end of the year for emergency use, and that sometime in the second half of next year, we'd all pretty much be vaccinated. That's exactly where we're at 6 months later, right? I said this back in March and April and May, and that means that starting next summer, the economy starts to normalize. The problem is that we're in such a deep economic hole right now that the whole buy the rumor, sell the news idea, I think, is at play. And I think that over the winter, especially in the next 2 months, there is the potential for some wicked volatility, as it seems that President Trump is trying to sabotage incoming President Biden. Maybe he's not able to do it, but if you're paying attention to some of the things that are being done with personnel, with regulatory things, with withholding access to the mechanisms of government, it certainly seems like the next 2 months could be very, very choppy. You throw in the fact that you still have the millennials who are pumping up the market with leverage and margin because, hey, the money printer goes burr. And now we know the money printer is going to go burr less. And we're at these huge resistance levels. It's not hard to see the S&P 500 coming back down into the low 300s, the SPY coming into the low 300s, right? So the S&P 500 would be 3,000, 3,100, right in there. And then it's a matter of at what point do people start buying the market again? And at what point do the millennials retrench enough so they have money, right? Because if they get wiped out in a sharp correction with their options and their margin, they might not have the money to put back into the market till they're, more fully employed. Although they seem to be doing better there than most. So I don't know. I think we get to here pretty easy. Here and here, hard to know. Really hard to know. At what point does the Fed step back in? I don't think they want to see this bottom again. I don't think they really even want to get close. So if I had to peg it, I'd say low 300s on SPY to the 270s on SPY is what we're going to see somewhere in there. And if anything bad happens internationally, maybe it goes down lower. I think that everybody here is on to something. And they're late to the game, right? These millennial traders are late to the game. I really think this is a good chart. But the fact that they're pivoting faster than the older investors and the fact that the millennials have been the marginal money in the market, I think is very important that we have to keep trying to wrap our head around how businesses work. And anybody who's owned a business knows your money is made at the margin, right? You have to pay all your expenses, and then the extra dropping down is for you. Same thing in the stock market. It's that marginal buyer that pushes prices up. And right now, the marginal buyer is a small guy, the millennials, aided by the hedge funds who have been chasing along with them. And the millennials are leveraged up, and they're using calls. So just like back before the financial crisis, there was leverage on top of leverage. And that's very dangerous. That's why the odds of this breaking out upward, especially now that the Fed is going to have a little bit smaller bazooka, I think is very unlikely. That's why I've been peppering in some puts on the S&P 500 and peppering in some puts on the energy stocks. One of the reports I'm going to update in the next 2 weeks is my peak oil plateau report. And I will tell you that this rally in oil is just nonsense. There is not really any fundamental reason for it. There's just people speculating that the price of oil is going to go up to $50 or $60 a barrel by summer. I just think that's asinine. The only way the price of oil goes up that much is if OPEC really decides to hold back. But if OPEC holds back, then the frackers start producing again. My advice to OPEC, and I have contacted as many of them as I could, I'm sure they've read what I had to send them with great interest, as I've told them, they ought to bury the frackers now. The frackers are vulnerable. Now that there's less money going to corporations, with the Treasury pulling some of those assets away from the Fed, OPEC, if they have a brain, will bury these frackers right now. And they'll make the industry consolidate to a dozen or fewer big producers, including the majors, and let the price of oil rise. Now, here's the thing. If the price of oil rises, who does better? It's everybody in sustainable investments. Why? Because clean energy becomes even more profitable as the price of oil goes up, because more people will want it. So companies like Ford, which I've talked about over and over again, are going to do fine either way. They have their gasoline crowd, but remember, EVs are more profitable for them than gasoline cars. People don't really wrap their heads around that, but once you get to manufacturing scale with an EV, it's a more profitable vehicle. Less parts, less people. When you take a look at energy storage, it becomes a lot more affordable as the price of oil and gas goes up, especially with technology driving the price of batteries and solar down. And there's a small offset because of the resources. But what did we just hear this week, right? You're going to have SQM double their lithium production in the next 3 to 4 years. So there's no problems with lithium. Some of the other resources, cobalt and nickel, are a little bit more scarce. But it doesn't take much for a company like Freeport-McMoRan to say, well, we haven't really been doing a lot of that, but we got it, so let's go get it. BHP, Billiton, Rio, whoever the case might be, you're going to see these metals coming out of the ground because the reality is there's a ton of it. We've barely tapped any of these resources, even with what we've been doing for the last couple hundred years. So there's no shortage of metals on this planet. And the newer technologies are requiring fewer and fewer metals and less of those metals. as they go to liquids and they go to air and they go to hybrid style batteries. They have 2 chambers, one for the long charge, one for, the transfer. So if this market comes down, and someday it will, what do we want to buy? We're going to want to stick with everything that's been on our barbell. Right? Our barbell is right. There's nothing wrong with what our strategy has been, other than we probably haven't been as aggressive as maybe we would have wanted to be. But the barbell philosophy is right. Through the 2020s, this is where we want to be heavy. Tech, communications, industry that uses tech well, which is why I'm high on several companies. They are fourth industrial revolution companies that nobody recognizes that way yet. They still think of them as an airline, or they think of them as a car company. They're really tech companies that build a product. And those are the companies that we really want to be involved with. Consumer discretionary is going to come roaring back, although I don't know how it's going to be for Christmas. I suspect that it's a pretty good Christmas season. Alternative energy, we just talked about. Biotech, there's a couple of companies out there that I'm really interested in. I am going to be adding 4 new stocks to the watch list next week. And I think that all of them are very close to being buys. One in biotech, one that has an impact on alternative energy, but is actually a materials company. It's a SPAC that I've talked about. And then a couple other technology companies. And I'll give you a hint. One of the companies, Howard Stern really likes. So as we get this correction to here, we start to buy, and then we would probably start loading up the truck here, keep a little bit of firepower in case momentum is down really heavy. So when I give you the buy orders, I basically give you these buy orders 1 and 2. And what you do when you get down to buy level 1 is, if everything looks horrible and it's still going down with a lot of momentum, you change this order, you make it into that order, or you lower it. So you don't have to have this order here if downward momentum is really bad. You can lower it, right? So this first order, not like in Star Wars, you have to be flexible with. You can move this one if the downward momentum is real bad. So when we take a look at relative strength index, if it's heading down into here when the price is at 300, wait till it gets down here, right? Are we going to get this again? I don't know. But when you go back far enough, it does happen periodically, right? So it's not like it doesn't happen that on the weekly chart we get oversold. No, the thing that I'm pretty sure we're not going to see is we're not going to see the monthly get oversold. So don't wait for that. But the weekly, it can get oversold. It happens from time to time. My guess is that we get down to about here, similar to 2018, but we don't get as bad as March. So probably in this area from here and here, when RSI gets in here, you got to be a buyer. I think that's all I have for today. I will take 1 or 2 questions because I didn't look online, but questions going forward really do need to be posted online. I did update fundamental trends quite a bit this week, and I am hiring a guy to help me with the website, a local guy. You'll see that I've changed the toolbars. In your section for your subscription, you'll have your link to your very short list. So whatever your subscription is, that's where your link to the very short list will be. I'll just update this from time to time. The resources are right here. You can take a look at the investor resources if you want. Getting started articles, special reports, which are about to get updated for year end, 3 of them. Retirement of 401k. I'm actually going to start putting up some free content for retirement and 401k. Hopefully Dividend Sleuth will be interested in that. The rare chat, still the rare chat. And of course, if you're not a subscriber and watching this, take a look at these services if you want to take a look. And if you're not ready to buy yet, get a free library card. That little kid will help you. All right, what kind of questions do we have? Yesterday I bought IWM, January 15th, $170 puts. So IWM, now IWM has really outperformed here lately, right? It's basically either it has to break out here or it has to retrace. Your big support starts kicking in around 160, right? You can see that. this is something that we ought to have on. I've started to put on all the charts. You want to know where the real big volume starts to kick in, right? So if you have $170 puts, you're not waiting for the price of IWM to get under 170 necessarily. You're just waiting for a big enough move that sends your premium up. I could see IWM down to around 160-ish, pretty easy. But once it got down to there, I would get greedy because you start to run into a lot of buying pressure. So 160-ish is probably where you need to sell that. Your premium on that, depending on time value that's left, could get up to 10-ish. But if you double your money on that, you really need to sell. Don't get greedy thinking it's going to triple. I know that everybody's always interested in ARK. So let's look at Tesla. Tesla, interestingly, has been chopping around in here and is running out of buying pressure, right? There doesn't look to be a breakout in Tesla coming. And if Tesla goes down, that pulls ARK down, and it pulls QQQ down, and now it'll pull the S&P 500 down. So I would be very cautious with Tesla and ARK and QQQ for the moment, because not only are some of the happy-go-lucky stocks, still through the roof, but when you take a look at the Semiconductor Index, you can see that this clearly is running out of buying pressure. I mean, where are the new buyers going to come from with unemployment going up and the Fed having less money? I think you really need to wrap your head around that. And it's overbought on the RSI on a weekly chart. So if you wanted an aggressive short, buy puts on the Semiconductor Index right now. That's probably something that'll be in the Swing for the Fences article, which I'm going to put at both websites. But the Swinging for the Fences, we really pay more attention to swing trading at fundamental trends. I think it's very easy to see, this getting down here. Realistically, I should probably have this buy zone. I went out to November, but these are getting hard to keep track of, so I'm just going to go out to May. This buy zone should probably come up to here, but I still think that this zone is probably where it should go. Doesn't mean it will, just means it should. There's a lot of things that should happen that who knows when and if they will. It's usually a matter of when, which can be a long time sometimes. So if you're going to buy S&P, iShares Semiconductor ETF puts, I think you can probably buy them roughly at the money, 340s, which will be more expensive. But I think it's a pretty solid bet. And if you want to buy a second batch down here around 300, 295, go ahead and kind of get both ends of this range. Just remember, if you're doubling and tripling your money, don't be greedy. Take all your money out plus some of the profit. So typically we don't talk about too many individual stocks, but we have today, so we will. Roku doesn't have big buying pressure until way down here. So I think that we can move this up to this 168 line, but I think that it's pretty certain to drop substantially at some point. For them to monetize their whole platform, it's not a quick thing. So, we should be very aware that it takes a long time to cut deals, takes a long time to turn it into advertising revenue. And right now, advertising revenue is low and probably isn't going to come back for a couple quarters at least. So if you wanted Roku in your portfolio, I'd say that's fine. But I wouldn't buy it until it's under 200 for sure. And you'd have to be pretty aggressive even to go up to here. The idea is that there's a paradigm shift going on here, but it's a very slow paradigm shift. The market can get impatient and then drive these prices down. If I were going to buy, I'd probably be, there's a 168 line and there's a 1 line. So this is where I'd be. Once again, my clicker finger is not good sometimes. There we go. So this is where I'd look to buy Roku, get in the 160s or lower. I actually think that if you were really trading, right, if you were a trader, pure trader, you probably could short this right here. So yeah, 2-3 weeks ago, I was on the chat room telling people that I was closing some of my puts 2-3 weeks ago. So when it comes to managing puts that you buy, your hedges, I can tell you what to get into, but you have to make your decisions based on when you want to get out. How much profit do you want to take? How much risk do you want to take? I've said over and over again, when I get profitable on a put, especially when I've made 50% or more, I'm taking money off unless there's huge momentum in my favor. I try to get to the point where I'm either have half as much risk as I started with, or I can get to the point where it's a free roll. So if I double my money on a put, which I did on all the oil ones, I took half off. The S&P 500 puts, I was only up, 30, 40%. And I reduced those because I could see that the market in the short term might go against me. So I have a smaller position, but right now I might add those again. And I'd probably go out to February. I'd probably add a month. So some February puts on the fact that the market hasn't been negative on today's news, which doesn't make any sense. And it's a little bit down, but if the Fed providing money, right? If the Fed providing money is what everybody's counting on, and they're going to lose a whole bunch of their firepower, what sense does that make? All right, why don't we call it a day? And everybody have a good weekend. You're going to still need to mask up, and I hope that everybody is careful at Thanksgiving. Have a fantastic weekend, everybody.